All right, episode 18. Today we have a special guest, Cody Laughlin. You're going to want to join us and listen in on this one because it's going to be the real, transparent truth of what's going on in today's market. We're going to go ahead and get started right now. Welcome back to the More Doors podcast. Today we have a great guest on. We've got Cody Laughlin on from Blue Oak Capital. You're going to want to listen in on all this. Go back and listen to last week's episode. It was a really good one because I wasn't on it. That's what Matt told me. He's like, it's even better when I'm not here. I don't know why he always says that. But if you do...
I don't really mean it.
If you're going to go and subscribe to our YouTube channel and leave some comments, just say, less Matt, more Nick. Especially on the ones that I'm not a part of. So go over to our YouTube channel, hit subscribe, leave some comments there, as well as wherever you're subscribing to and listening to a podcast and consuming that, go leave us 5-star reviews, and then go support our sponsors, right? Our shows are brought to you because of our sponsors of Deep Blue Capital. So if you're looking to, maybe you got some money that you need to invest, you're looking, especially toward the end of the year right now, you want to get your taxes right. I'm going to tell you, I'm really afraid of taxes right now, so I want to make sure that
mine are being done as we speak.
That's
man.
right. I just saw an email go out looking for another form.
Yep.
And so, if you want to look at how to maybe offset some of your taxes, you want to look at where we're putting our money, just go over to deepbluere.com, sign up there. We just sent out a newsletter of one of our most recent acquisitions and the update that's going on with that. So we do share a lot of our stories with what's going on over at Deep Blue Capital. And then if you are looking to make video content or you're looking to make a podcast just like this one, then go support and go check out tourstudios.com. You're going to want to get with Jesse Showalter, our amazing producer. Does a great job making us look good because it's hard to do that with me and Matt here.
Oh, at least me, maybe not so much
well,
you.
Both of
you're
us.
the best host ever.
Best host ever.
I'm just the the
but
underling.
when I'm not here, you say you're the best host.
I never said I was the best host. I don't even get to do the intro. You and Brian always do the intro.
That's
I'm
right.
I'm a glorified co-host at best.
No.
I might as well be an intern at this point.
We would never see you as that. So, all right, we want to bring in Cody Laughlin. If you could, we've got Cody. I did a call with Cody yesterday, and as I was bringing this up, and I'll read his bio here in a minute, but when I was talking to Cody, there was something that I really loved that he brought up, and we want to prepare for the show and really make it valuable. And he's like, if you're okay with it, and he's okay with it, just being transparency, the good, the bad, the ugly of what's going on right now.
Yeah.
Because there's a lot of operators and syndicators that, shit has hit the fan.
Yes.
But they're still posting like everything's great.
Yeah.
They've never done any bad deals. They're still making money left and right. They're only making the best investments. Mm-hmm. Everything's going up. And then behind the scenes, Brian and I are in 3 or 4 deals that aren't going so sexy right now. Right? The other one, in Waco's doing a great, but that's 1 out of 5.
Yeah.
That's not a passing grade, by the way, Matt. 1 out of 5.
Oh, okay, good. Thank you.
Yeah.
So lower is not better in this circumstance?
No, not
okay.
on this one.
Okay.
Not on this one.
Less is not more?
Less is not more. So if you go listen to Gino Barbrio.
Dude, what is with you? Do you even take Italian in school?
No.
What's the matter with you?
No. Barbero.
Dude, in New York, you'd be shunned.
I go to New York all the time.
You got to be careful.
Yeah.
That's Times Square. That doesn't count.
I don't go to Times Square. I'm not a tourist,
I've seen you in Times
One
Square
time.
with your name on the thing.
That's
and
right,
you're
one
like,
time.
Instagram storied out. I saw it.
Look, they flew me out there to do a show.
Okay.
What am I going to say? I'm going to turn it down? Be like, no, because I can't pronounce Italian last
Exactly.
names.
Let me ask you a question. Serious question. You go to New York a lot.
Yes.
Do you fold your pizza, or are you the guy that's like that?
No, I fold it.
Okay, good.
Yeah. First off, next time I need to take a photo. Do we have that on video, Jesse, of how Matt just did that? We do. All right, great. So while we're warming everyone up for that, Cody Laughlin is the co-founder and managing partner of Blue Oak Capital. Mr. Laughlin is the director of acquisitions and chief investment officer and oversees the company's acquisition and business development. Cody has 11 years of experience in alternative investments. And prior to joining Blue Oak and starting that, Mr. Laughlin was the founder and president of Laughlin Investment Group, which was a privately held real estate investment group where he managed the company's acquisition portfolio of residential real estate. And in addition to his entrepreneurial ventures, Mr. Laughlin worked as a registered nurse at the Texas Medical Center, and he has a graduate of McNeese State University with a bachelor degree in science of nursing. It's a lot.
So honestly, like you almost fumbled on Texas there. You're worried about Barbaro. All right, we gotta get you some help before the next show.
It's been a long look. Been on vacation, man. So let's bring Cody in.
I'm sitting here waiting to push this.
There he is.
I'm waiting to unmute button because I wanted to jump in this opening monologue. Man, I'm disappointed. I'm sitting on the sideline here.
Yeah, I mean, we should have brought you in for all of that. Yes. I mean, can you say Italian last names first off?
Can you say Gino's last name?
Barbaro?
Thank you.
But you're part of the Jake and Gino group.
Yeah,
it's
but you
probably
don't say it's not the
Barbaro.
Jake Stenziano and Gino Barbaro group. It's
Barbaro.
Jake and Gino.
Barbaro.
Yeah, okay.
I'll get it.
Okay. It's
Barbaro. Look, no one pays me to say their last name correctly.
Fair point.
Right?
Fair point.
Like we're here. I'm the muscle. Right? I'm here to look. If you're not paying your rent, I'm coming to your house. I'm knocking on your door, and it doesn't matter how I say your last name.
You're the beauty, not the brains, right?
That's right. You know, it's the brawn. So Cody, with that, you know, look, we always go over people's bios, but I want you to give us the real version of that, right? That's the sexy version. You know, you started Blue Oak. You're a co-founder of that, and then you had your own company before that. But let's get the real Cody. Like what were you doing when you were buying residential? What were you doing? Were you just nursing before that? Like, kind of walk us through all that.
Yeah. So I started my W-2 career in nursing in 2008. You know, my wife and I are both natives of Louisiana, both enrolled in the nursing program, graduated college, moved here to Houston to start a W-2 career in the Texas Medical Center here in Houston. And we spent about 2 years in our first starter home in a particular part of Houston that we weren't very familiar with when we first moved here, but it was all we could afford. And in those 2 years, we started to discover, like, hey, we really wanted to be in a better demographic, a better area of Houston, you know, a more suburban area of Houston. And we had worked about 2 years into our career, and we kind of started getting some financial stability. So we decided, let's go ahead and try to move to a different part of Houston. Well, we bought a second home, and we had the intent to sell the first home. And the unfortunate thing is the real estate market was still in the, you know, rock bottom of the, you know, wake of the great financial crisis, and the housing market hadn't begun to recover yet, and we couldn't sell that first home. So here it is. We have two mortgage payments. We couldn't afford to pay both, and we were in a financial bind again because we were, you know, trying to figure out how in the world do we get out of this problem. And so the immediate solution was, hey, we need to go find a tenant to rent out our home, our first home, and we can figure it out from there. And that's exactly what we did. So, you know, my real estate, my introduction to real estate was really nothing sexy. I actually stumbled into it by accident. And through a series of other events, both from kind of a macroeconomic situation as well as just some self-learning and discovery, I guess, I really got the bug for real estate entrepreneurship. And from there, you know, really just kind of went down that path while still maintaining that W-2. So to answer your question, you know, Nick, I've done everything in residential real estate, from buy and hold, wholesale, you know, direct to seller type campaigns, was looking at tax liens for a short period of time, single family flips, you know, so I've kind of run the gamut, so to speak, in the residential space. Also did some non-real estate related business ventures. You know, I tried buying into a fitness franchise, and you know, spent in total about $150,000 invested in that, and lost in trying to get a fitness franchise started. That never transpired. And you know, I just spent about 8 years of grinding away, putting in this time, effort, money to really not find any momentum, not find any scale, not really find something that was really, leading me down the road of financial freedom that I was hoping to find. And, fast forward to 2019, I, started to finally discover the idea of multifamily syndication, right? The economies of scale that come along with multifamily syndication. And it just made sense for me, right? I mean, instead of trying to go buy 200-300 single family homes and collecting a couple $100 of rent on each of those a month, I can now go buy, 100 unit, 200 unit apartment complex in one transaction and accelerate that economies of scale. And so started down the journey of becoming a multifamily syndicator 2019 and met some very good partners. We launched Blue Oak Capital, and we've been able to do 7 successful syndications to this point, and here we are. So
nice, Cody. I don't want to reopen any old wounds, right? But I think there's a lot of people out there that just they don't hear about the failures, right? So tell us a little bit high level, like what happened with the fitness thing, and what'd you learn from it?
Well, first and foremost, Matt, to that point, look, every successful person that you see, whether it's real estate, whether it's any other business, their successes are all standing on top of a mountain of failures, right?
There you go. Agreed.
That's first and foremost. So you see all the flash and you see all the good stuff, but you never hear all the pains and mistakes made along the way. So going back to my story, look, it's very relevant to a lot of people because you jump in and you get started and your will overpowers or overshadows your lack of education, right? I have a strong desire to go out there and do this, and I'm going to work my tail off. But when you jump into an investment where you're not educated, or you haven't done enough due diligence, or you don't have enough resources, it really leads you to a path of making a big financial mistake. And that's exactly what happened to me. I had this passion for fitness. I love working out. I used to live in the gym. I actually used to look like Matt or close to it, Matt and Nick, you guys, years ago. And so I took that ambition and that passion and said, okay, great. I'm going to go invest in a business that serves my passion. And the point of it is I want to transition out of my W-2 and operate this business. Well, I collected a few partners, gathered a few partners that kind of shared a similar business interest and such. And we just dove all heads in, we just dove straight in. And because it was my idea and it was because I was kind of leading the initiative to go take this on, I kind of leveraged at the time my little bit of liquidity and most importantly, my credit to go sign into this franchise. And there's so many mistakes. I mean, it's probably another whole podcast series just on this one event in my life. But long story short, I invested in a new startup franchise that really didn't have a lot of support for new franchisees. I didn't do enough of due diligence about what type of resources, how many resources do you need? Because it's not just the initial franchise agreement that you have to sign, which comes with the financial commitment, right? You have to have liquidity for financing of equipment, for guarantees on your lease contracts that you're signing to occupy certain spaces, and all these different things. And I got into it realizing all these variables after the fact, and I realized we don't have enough to get this gym open. And we tried for about 3 years, going through each headwind, going through each milestone to try to overcome and figure out how do we troubleshoot that. And make a very long story short, after about 3 years, I had all but one partner back out of the deal. And eventually he ended up backing out, and I was left here with a $50,000 franchise tag that I had leveraged using line of credits and, made some other contributing investments to get these units open that never transpired. And yeah, we never did get a unit open. So it cost me about, like I said, after it was all said and done, probably in the ballpark of $150,000. So,
wow.
Let me ask you this: how was your mental headspace on that? Right, because a lot of people that go through and take these punches. I was listening to a podcast today. I started 75 Hard. I'm on day 2, and so I'm consuming all these podcasts now, doing my outside workout. And there's when things happen to people, people retract, And the way they talked about it is like with technology. They were talking about these self-driving cars, and this self-driving car ran over a lady. Really wasn't the self-driving car part, but what it's doing is like now all these people are saying, no, we don't need this technology. And it's actually, they were saying how, there's more deaths caused by human error than technology itself. And it's going to just hold back that. And a lot of people have that same mindset. So you invested in this business, and your group of investors probably had this, you probably visioned the end of the rainbow with all that gold. And it was really exciting. And then all of a sudden, 3 years later, you're left there holding the bag with $150,000 gone.
Yep.
And I mean, for most people, they're probably going to be gun shy on doing any other investment, just because that's not real estate related. You would probably be gun shy on pulling the trigger on any other type of deal. So kind of walk us through your headspace on that. And then, you went in 2019 and now have done 7 successful syndications.
Yeah, look, I think, man, it was a multitude of emotions, right? I mean, there was a period of time of feeling defeated and feeling like I had put such a financial burden on my family. $150,000 loss, that's a big loss to overcome. And, it took several years to overcome that loss. And at the time, my wife and I think we were married for, just about 8 years. And I had 2 kids at this time, and so it was just a big impact on our family. So it was a lot of disappointment, frustration, again, that feeling of being defeated. But one character trait that I have that I've always had is I'm a little stubborn, a little hard-headed, and sometimes I can be a little prideful. And I applied that defeat to and leverage my stubbornness to say, I'm not going to let this keep me down. I'm not going to let this beat me up and knock me out. I'm going to learn from this, and I'm going to go be bigger and better. And it took, and that wasn't just me. I had that ambition and that drive, and I had the ability to kind of pull myself out of that kind of wallowing, so to speak. But it was also my wife too, man. My wife, she's such a supportive person, and she's really been kind of my rock and pushing me through. And I remember she was sitting me down, roughly about, I don't know, maybe a year later after all this stuff transpired with the gyms. And we were having this conversation about kind of our financial goals. How do we recover from this? What do I want to do long-term with my own career and financial path? And she said, look, you need to quit messing around, and you need to quit jumping from shiny object to shiny object and doing all these things. You just need to get hyper focused, put your head down, and just focus on one thing, and just do that. Like quit doing all these other things that you keep trying to do. And it was in that conversation that was really kind of the gut punch. That was really what I needed to kind of knock some sense into me, so to speak, and say, okay, the one thing that I've always came back to, the one thing that I always had a passion for after getting started was real estate, right? Mm-hmm. And it was after that conversation where I said, you know what, you're right. No more distractions, no more trying to do all these other things. It was just, hey, heads down. We're going to dive into real estate. We're going to do what it takes to be successful at this. And I'm not going to deviate from it until we do get successful, right? And so that goes back to the stubbornness. Now it's just like, hey, blinders are on, and no matter what lumps and bruises we have to take along the way, we're committed to this process. We're going to trust the process, and we're going to see it all the way through. So
I love that. So Cody, number one, thanks for being vulnerable. It sounds like a tough story and a kind of tough time of your life with your family, and special thanks to your wife for kind of keeping you in check and getting you back on the course, right? I don't want to dwell on this. I think that's a great story, and honestly, I think we've all, as business people, suffered from something like that or encountered that. Some of us multiple times, right? Before you get it right, but you got to keep going, right? It's that scene from Rocky 16 where it's not about how hard you hit, it's about how hard you can get hit and keep getting up. And it looks like you went down in the third, but you came out victorious. So fast forward, what gets you into the syndication market in 2019?
Well, again, just really evaluating what I wanted to do in the real estate space and understanding kind of what my motivation was and my timeline, more importantly. For me, like many other people getting into real estate, you hear the success stories and you're like, hey, I want to use real estate as an avenue to transition out of an earned income, a fixed income, right? And so I wanted to put myself on a shortened timeline to make that exit out of healthcare. And so that's what really led me into the idea of multifamily syndication. Again, you have the economies of scales, you have teams, you can leverage other people's money and resources to go buy bigger deals, which hopefully would equate to larger profits, right? And so that really what got us jump started in 2019. I started out looking at small multifamily, kind of limited mindset, thinking about my own resources and whatnot. And when I discovered the power of going larger or bigger faster, I went on a property tour at a networking event. We toured a couple larger communities and just was hearing all of the conversations around how easy it is to acquire a larger building from a debt perspective, raising capital, asset management, property management, all these things. And I made that mindset shift to say, okay, I need to think bigger. I need to quit putting limiting barriers on my own mindset and really get out of my own way and go ahead and scale this thing. And I love talking to people. I love networking with people, and everything we do in real estate's all relationships, right? It's all about who you know and who knows you. So, I started thinking bigger. I started building out a network, and that's how I met my partners. And that's how we started building our database that allowed us to go out there and start syndicating. And we did our first deal in 2021 and in May of 21. And we ended up doing 2 other deals that year and a few more the next year. And so it was just a big snowball after that. So
that's awesome. That's awesome.
Yeah.
So I think Nick texted me yesterday after you two hung up the phone from getting to know each other, and he was super psyched about kind of the topic for today and what's kind of really going on out there. And Nick is by definition a little cynical and loves to kind of pay attention. He admitted on a show a couple of weeks ago that he loves to read the 1-star reviews. Right?
Yeah, that is,
see,
yes.
I pay attention.
Yeah, you
pay
do.
attention.
Yeah.
So why don't we dig into that? Because I know, Nick, this is something you're super passionate about.
Sure. I mean, look, you've been through all the 7 syndications. Have you fully dispoed all those?
No.
How many have you successfully turned?
None. So we still are invested in all of them, right? So we still own. So this goes back to, I guess, the start of this conversation, right? Is if you go back and look at my journey, it's starting in 2010. I was just starting in the very end of the real estate downturn of 2008, the great financial crisis, right? So it was really at the start of the next expansion cycle, which really lasted over the 12 years getting up to this point. And I bring that up because most people in multifamily right now, particularly in the syndication space, has only experienced nothing but economic expansion and tailwinds, right? Everything has just been up. You didn't have to be a prudent or savvy investor to go make, millions of dollars over the last several years. And you go back into midway last year and things have fallen off a cliff, right? I mean, you talk about hard times. I mean, I don't know that we've ever seen such an abrupt or dramatic shift or contraction in a market cycle in such a short order like this ever. And most people don't know what to do because this is their first downturn that they've ever gone through, right? And so people are really learning on the fly about how to be great operators, how to really manage these properties, because now more than ever, it takes every bit of the skill of the operator to make sure that you can execute these business plans to keep your deals alive, right? I mean, and let's be clear, right now, everybody's operating under the mindset of survival mode. It's not, hey, we're trying to go maximize these returns and be award winners. No, it's we got to survive and just preserve everybody's capital, and that's exactly what everybody's doing right now. And so it's incredibly difficult market to navigate. And going back to the point is all everybody knows is just growth and expansion and happy times. Nobody really knows the pains of a downturn, which everybody's learning the hard way right now. So
and people don't like to talk about it, right? So like, again, we brought up at the beginning of the show, there's operators that are going through, they've got some tough times on their projects.
Yeah.
But if you look at their kind of social media presence and their marketing presence, you would think that nothing bad was going on and that they are only investing in the best deals. And, and to me, I don't know. To me, that I would want to, and Cody and I talked about this yesterday, is like, look, you don't care who's flying the plane until you're 36,000 feet in the air, and then all of a sudden there's turbulence or plane trouble. And you're like, God, I pray that this pilot has the experience, know-how, and expertise to get me safely on this ground. Right? Versus inexperienced operators who are going to crash it and burn it and lose everyone's money.
Yeah.
And so, you guys acquired 7 properties. How has that been, so far, right? Because, you got the majority of them with lower rates, correct?
Yeah. So if you look at our portfolio as a whole, we have 7 assets in total. So we have 5 multifamily, 2 industrial properties. And of those, 4 out of those properties are performing well, right? We have agency, long-term fixed rate debt. Those properties are going well. And then we do have 3 deals that were acquired on variable rate bridge debt that all have interest rate exposure, and one that does not have a rate cap. And that's the one that's causing us the biggest chest pain because, as everybody knows, rates have, expanded over 550 basis points the last 18 months, and it's absolutely crushing us. So we're having some pain. I mean, we're no different from anybody else out there in the market right now. We do have some exposure in the market, and so every single day of our time is spent like, hey, how do we get through these challenges? How do we, find a way to overcome this exposure? How do we get our exposure down? What are the different hurdles that we need to resolve so that way we can continue to keep this deal, like I said, keep this deal alive and keep pushing forward. And, most importantly, it's not just about us and the success of the deal for us. It's about the, 10, 20, 30 investors that have invested with us and have a couple $1 million of their own hard-earned capital tied up in these deals that we have a huge obligation, responsibility to, right? And so it's kind of everything that we can do to really preserve their interest and preserve their principal so we can get them their money back. And it's tough, man. So to your point, look, I think this whole thing about social media and stuff like that, and I'm a victim of this, man. It's a copycat league, right? Everybody's out there doing the same thing that the next guy's doing, especially on the marketing front. Everybody's kind of marketing in similar fashions and promoting similar things. And I'm not saying that's wrong or good, bad, and indifferent, but it goes back to your point of like, you really have to peel back the curtain and really look under the hood to see, what's really happening behind the scenes. And I don't know about you guys, but look, personally, coming out of this, the ones that make it out of this are going to be the true battle tested operators that will have or be the best operators coming out of this downturn. And those are going to be the guys that you really want to stand behind moving forward because they're going to have that experience to get through these challenging times. And I don't think a lot of people are going to be able to say that at the end of this.
I agree with you. So many things to unpack there. And the first thing is, I've said this to Nick and Brian like 100 times, right? I'm a big believer in this concept of nobody hears when a plane lands safely, right? And I think when you think about that in the context of multifamily, actually, people love to celebrate when their plane lands safely, right? And they get the big exit, and they did the 3-year return instead of a 5-year return, and everything's hunky-dory. But nobody wants to talk about the ones that crashed, right? And there is absolutely risk when you're putting money into a deal, and real estate, may go up over time, but there's definitely going to be blips like there is, going on right now. I think the other thing too is I agree 100% with what you said as far as the people that make it through this are going to end up being kind of the next generation of large-scale syndicators and investors. And one of the many reasons why I think Brian, Nick, and I make very good partners is we approach everything like a business problem, right? So when we were having, lead follow-up issues and lease-up challenges, Nick deployed his team of VAs in but we had a meeting at 9:30, and by noon that gap was filled, right? And we had processes, and we had people, and we had things that we could deploy and tactics that we had used before to solve business problems. And we have attorneys that we can fall back to, and property management teams we can get advice from, and stuff like that. And it to me, this kind of paradigm that we're living in is who can solve the most complex business and financial problems as quickly as possible adapt and find ways to either get over the or through the issue.
Yeah, Matt, you bring up a really good point in that if you look at most people that are coming into this space, it's not business oriented people, right? I mean, it's sophisticated people. Sure, they have certain, levels of education and whatnot, and they come from various backgrounds. But overall, coming from an operations background or business management background, a lot of the guys that you see in the space are just everyday people like you and me. I'm a nurse, and I transitioned into real estate, but I didn't come from a finance background, or I didn't come from a business background, and I had a failed attempt at trying to start a business and such. But the point is a lot of people came into the space not having that experience of owning and operating a business, which, let's be candid, that's what this is, right? We talk about the real estate and apartment buildings, but you're owning and operating a small business.
That's right.
And again, people getting in, 3, 4, 5 years ago, you didn't have to have a lot of skill set. The market carried you. You could have made every mistake in the world, and chances are you still made a reasonable exit, and you still look like a rock star. Now is where you really get to see who's sophisticated and savvy enough to acquire those skills you need to operate these small businesses, and, like you said, get through those challenges. And it's good that you guys have a great working team and partnership, and that operates in that manner and thinks in that manner. But that's, I think, a lot of the struggles that you're seeing across the market is people are, again, they're learning how to operate small businesses on the fly right now, it's a hard market.
Agreed. And there's been a lot of mania around investing in multifamily and mastermind groups and coaching programs and all kinds of stuff. But there was no playbook written for this, right? There was no appendix at the back of your seminar workbook that says this is what you need to do if you underwrote for 3% insurance growth and it actually is 15 or 20. Mm-hmm. Or if you're underwriting at 80 or 85% of your purchase price for property taxes, and then all these state and local governments are like, well, we need some of that printed money back from COVID, and guess what? Here's 100%. And it's going to be that way for the foreseeable future. There was no playbook for that, and I don't think anybody saw this coming. So right now, it's absolutely survival of the fittest, survival of the smartest, and survival of those that can take very quick, agile, decisive action to protect the investments that their investors have made.
Would you say it's the smartest, or the ones that have the intelligence on problem-solving skills? Because I know a lot of intelligent people that get stuck in the weeds, and they don't know how to solve the problem. So take, for example, right, Cody and I were talking yesterday, and you just brought it up, property taxes. Like, property taxes went up in Denton County like 41% on my stuff. Like, it's hard to take that hit.
Yeah. Right?
Luckily I don't run in all bills paid developments, but like our deal, our student housing that Deep Blue has in Waco, it's hard to underwrite for a summer of 115-degree heat.
Right.
And where we're paying electricity.
Yeah.
And say, how do you underwrite for that? And say, well, hopefully next summer we don't see 120, or we don't have a repeat of that, because that wasn't in the plan. So how do we budget for that? And we started putting measures in place, right? So I'm assuming, Cody, you talk about how your background, you didn't come from a finance background, but you came from the nursing field. Mm-hmm. And look, I wouldn't downplay that, because you had people's lives in your hands.
Sure.
Right? So, and you have to follow protocols and very system oriented. Mm-hmm. Where there are some people, syndicators, that got in more for the flash and the fame and quick, easy money. Mm-hmm. Yeah. And we still see that today, unfortunately. Agreed. Right? We see, unfortunately, out there, bad apples, syndicators who have to raise money because that's the only money they're making is on the acquisition cost. They don't care about the rest of it. It's just the acquisition management, and then screw the rest. And you said something that really hit home, especially on the one project that you have that's on that floating bridge debt, which is you've got, what'd you say, 20, 30 other investors, and you want to make sure that you're really looking after their money.
Yeah, no, absolutely. It's a huge responsibility, right? And I think going back to the comment about, who is it that can navigate it? It's people that are going to be successful during this downturn are people that are proactive, in problem solving, to your point, identifying problems and getting ahead of those problems before they actually occur, before they get to the point where they're, like I said, shit's hitting the fan.
Yeah.
But also people who are detail oriented, right? You need to be able to really get into the weeds in your property, both at the property level and to the financials, and look at every single line item and see, okay, what's a necessary cost? What's a necessary cost reduction? How do we preserve every single dollar of operating capital into this deal to make sure that we can continue to have capital to survive again, right? And those to me are the guys that are the only ones that are going to make it out of this, because if you're not proactive and you're always reactive, you're already too late. If a problem's already hit your desk and you're running around trying to figure out how to solve it, you're too late. It's, and you don't have the time in this downturn to really work through those challenges, right? So there's that problem. If you're not detail oriented, you don't know what to look for, right? If you don't know what details you should be looking at, it's going to be very, very difficult for you to find your way out of these troubling situations. And when this first started, man, you heard this term survive to 25, or the phrase rather, survive to 25. And I hated it. I couldn't stand it, but man, it's so true. Like the writing is clearly on the wall now that we're going to be in this for a longer duration. We still have another 12, potentially 18 months of headwinds to go through before we really start getting at the back end of this cycle and hopefully enter into the next growth cycle. So having said that, I mean, you got to hang on for the ride here, and you got to really, really figure out a way to keep troubleshooting. And it's constant. Like, it's not just, okay, we fix this problem, we're good. It's every single day and every week and every month. The level or the margin of error is like razor thin right now. Like, you know what I mean? And so you really have to have the ability to be proactive and identify those issues ahead of time. And I think, going back to your point, man, like my skills in the nursing world, my entire nursing career up until a few years ago was in critical care, ICU settings. And so every single day you're faced with life or death decisions. Every single day a patient can turn, and you're executing life-saving measures. So you always constantly have to be thinking proactively about identifying, trends or certain things that could happen to this particular patient. And you have to be very detail-oriented as well to navigate those very challenging circumstances. So that's transferable into what we do on the business side, I feel like, and especially what we're seeing now. Mm-hmm. So I'm very fortunate for that experience, but it's been tough for sure.
I hear you. So question for you, Cody, as you and your partners continue to attempt to grow your business, and it has been very challenging, right? There's still a big gap between buyers and sellers. And I was just having a conversation with someone this morning that every OM I still read has all expenses going up by 3%. And then the same broker on that deal is on LinkedIn saying, be ready for 10 or 15% annual insurance growth. I'm like, but you didn't have that. It's not in the OM, dude. You said 3%.
Uh-huh.
And so it's very clearly a disconnect. So question, how are you and Blue Oak Capital recalibrating your underwriting criteria based on today's market conditions?
Oh man, I tell you what, it's incredible, because you're having to account for so much more of a higher or inflated operating model, right? Yeah. Operating expense model. So, going back to your comment, somebody made a comment a minute ago about a 15 or 20% increase in insurance or taxes. Man, I wish I'd have taken that all day long in this market cycle, because our one property, we saw an 80% increase in the insurance renewal and a 3x increase in taxes.
Wow.
So it knocked off, like, this is no lie, guys, $400,000 off our NOI between those two non-controllable expenses. Nothing changed on this property. Operating smoothly, perfectly. $400,000 wiped out from those two reassessments alone this year. And so, you talk about a trifecta, right? Rising interest rates, taxes through the roof, and insurances that are equally as prohibitive. It's been remarkable. So going back to your question about, like, okay, well, how are we accounting for that in our underwriting? Well, man, your operating model, it looks so much different, right? Where used to historically, you may be operating at about a 50% expense ratio. Shoot, you may be closer to 60% right now. Because the other dynamic here is it's not just you have rising operating costs, rising, non-operating or non-controllable expenses. You have payroll costs are increasing. Wage inflation is still a problem, right? So to find good talent is incredibly difficult. When you do, you have to pay a premium for it. All of your contract services, your vendor services are all going up. So all of your expenses are escalating. But then you have a moderation in the top line, right? You were seeing a retraction in rent growth. You're seeing a moderation in rent growth. Absorption rates are kind of moderating back to historical norms. And it's, you can see it at our property levels that these residents are feeling the impact of this economic environment. I don't care what the headlines say. I don't care what the economists say about how strong the economy is or whatever. To me, it's all BS. I mean, our residents, you can hear it, right? They are feeling the cost of this higher cost of living environment that we're in. And so that means that your ability to go and really force the value and increase rents in your models, like you would think, it's really hard to find in today's time. So our underwriting models are much more conservative, and I know everybody says that. I hate using that term, by the way, but we're accounting for at least a 15% increase in both taxes, insurance on our models. At least probably about a 5% increase at a minimum in operating expenses for the year, and a very moderate, very, very moderate increase in top line revenue, because that's what we're seeing right now. I mean, that's what's happening in the market. So the models look very, very different now than what they did 12 months ago. I'll tell you that.
Yeah, absolutely. How are you? What are you guys doing, just out of curiosity, on like exit cap rates? How are you adjusting there? Because I think everybody a year and a half, 2 years ago was just like, it's going to be 3, it's going to be 4, it's going to be 4.5. Don't worry about. And now it's like, whoa.
Well, man, that's the struggle, right? And that's really why a lot of people have angst in buying new assets right now, is because we really don't even know what your going in basis is, right? We still haven't really filtered through this price discovery across most markets right now, because there's not a lot of deals trading. There's not a lot of transactional volume. Our borrowing costs are through the roof. And, going back to everything that we just covered, it's very, very hard to come up with a very predictable model or pro forma that you can have conviction in or confidence in. And so, to be honest with you, I mean, your cap rate assumptions really have to be rooted in kind of what historical trends have been, dating back to probably, I would say, pre-2021. I mean, at least that's what we're seeing in the deals that we're looking at now. I mean, we're starting to see values kind of reprice around, the same values we were seeing in 2019, 20. So kind of using that as a baseline to kind of assess where our potential future forecast will look like, looking at forward curves to kind of get an idea on like, oh, okay, what does the Fed say that or predict where long-term treasuries and markets are going to be, so we can kind of get an estimate on how that's going to impact our cap rate assumptions. But to be honest, Matt, I mean, I'm telling you, it's so hard right now. It's a moving target, and I don't think you can just apply a simple 50 basis point reversion on top of your going in cap rate right now. I don't think that models applies right now. So
yeah, I would say, we agree with that, right? So we've started to look at historical cap rates in our markets going all the way back to 2017, 2018. Mm-hmm. And, is our exit cap on this particular underwriting at or above the highest point that localized cap rate has been in the last 5 or 6 years, right? Because I think everybody's comparing to a year or two ago, and that was just a different market, a different time, and you're setting yourself up for failure, right? So we've started to do that. We've made adjustments to insurance. We've made adjustments. We only underwrite now at full purchase price at times the mills rate on our property taxes. This deal that we did earlier this year, property taxes, the assessment came in 50% higher than what we paid for the asset. Mm-hmm. And we had to spend $10,000 in order to appeal that, right? So and
by the way, that's a racket. We got to figure this out.
Yeah, because we start a fund for that.
I spent close to $100,000 appealing my other stuff, and I'm like, it almost feels like a wash.
Yeah.
Because it's like it's a domino effect that you have to keep kicking the can down the road, and it's like we need to do that business.
Let's do it.
Yeah, because that's we got to fix that.
Blue Oak Capital is going to be our first customer.
That's right.
Let's go. Sign me up right now.
But it to your point, it's very different. We've started to pad our vacancy numbers, not necessarily for physical vacancy, but economic, right? I mean, to your point, is across all asset classes. I think everybody's feeling a little of a pinch right now. I heard something on the news that the average household has been seeing their expenses go up by $700 a month, and that's material to a lot of families out there, and a lot of those families that want to live in apartments.
It's huge, yeah. It's
right.
huge, man. Yeah, absolutely, man.
So I think it's a very interesting time, but we going back to the kind of business problems thing. I think we've done a very good job through data and frankly through some very passionate conversations about what is our buy box, what is our criteria, what are we underwriting against. But we're also thinking ahead, right? You mentioned something about being proactive, which I could not agree more with. We saw certain expenses on a number of our assets go way higher than expected. And you can sit there and you can look in the rearview mirror, or you can look in the through your windshield and say, okay, these were my expenses in 2023. How do I take my utility expense divided by my number of units divided by 12, and that's my new RUBS number next year, right? And chances are, there's never any guarantees, but if you don't get a rent increase in 2024, but you can increase, you need to increase your utilities to keep up, they're always going to remember that the air conditioning worked, right?
Right.
And you're probably less likely to lose that tenant over a utility increase than a material rent increase.
Correct.
Look, what you're talking about right now, Matt, is in my opinion, absolutely so key, because the properties that will be able to weather these challenges as far as rising costs are going to be the ones that can deliver the best and highest customer service.
Yep.
Right? The better customer service that you can be and giving these people a very efficient home that they're proud of, that they want to stay in, and that they're incentivized to stay in. Forget about the rent growth, right? Forget about all that other stuff. If you can retain your residents over the long run of your life cycle of your deal, it's going to be much more cost effective than trying to go acquire a new tenant. And right now, residents are looking for, hey, what's the cheapest option that I have that I can afford? So if you deliver that customer service and give people a home that they don't want to move away from, that's your only way of survival right now. Because the cost of acquiring, again, new residents, it's too costly. It's going to cost you dearly. So going back to your point, man, it's all customer service driven right now for sure, more so than ever before. So
I completely agree with that, and I think I challenge all the operators out there, the owners out there that you leverage third party management. Pay attention to your Google reviews. Pay attention to your Aura scores. Pay attention to some of the indicators on your monthly remittance, right? Typically, when you see economic vacancy start to increase, or your delinquency start to increase, you may have some unhappy tenants, right, that don't take where they live to be their number one priority because they don't feel like the number one priority from your property management team. And I think getting out there, visiting the properties, talking to your leasing agents, talking to your property management team, holding them accountable, like from time to time, just audit how long it takes them to review and close out service tickets.
Yep.
There's always improvement to be had, and at some level right now, especially right now, I think we as operators really need to be in the almost micromanagement phase and make sure that every I's dotted, T's are crossed, we're running optimally, and we're not leaving anything. We're leaving as very little at risk as possible, I should say.
No stone goes unturned right now. Absolutely. And you said it correctly, man. I think micromanaging is the key. And I know that typically can be a bad nomenclature, but really it's true. I mean, you have to get in the weeds right now. Asset managers are more involved in operations than ever before, in my opinion. At least the good ones are, because to your point, you cannot just assume that everything's going to be executed the way that you laid out or you're expecting. You have to make sure every detail is, like you said, all the T's are crossed and all the I's are dotted, and no stones left unturned, for sure. I agree.
Agreed. So last question here before we wrap up. Look, I think, Houston's been kind of taking it's had a tough go of it the last 12 months or so. So
Raked over the coals. Yeah.
yeah, dude. And it was a darling, right, for a long time. And then, I feel like the brakes pumped. I was just down there, as you know, traveling to see some customers. And, I think they've seen unprecedented occupancy, right? They saw occupancy dipped and absorption problems and stuff. So, just from the ground level or what are you seeing in the market, and what do you think 2024 holds for the Houston market?
Yeah, look, I think to kind of summarize everything that we've discussed already, the environment that we find ourselves kind of getting in now, or kind of slowly working our way into, it's really a moderation back to historical norms, right? Where you're seeing more historical operations as far as your economic vacancies, your occupancies, and things like that. The one variable, like I said, is the operating costs that are much higher now. But overall, from a leasing perspective and top line revenue perspective, you're kind of seeing that moderation back to historical norms. But that, in my opinion, is what the challenge is. Not the environment that we're going to be operating in. The challenge is how fast we had to go from, climbing the Mount Everest to falling off Mount Everest. I think that it's like you took a gut punch, really 3 gut punches back to back to back, and you had to, you didn't have time to really absorb those impacts. And that's what this year really has been. I feel like is we fully absorbed the impact of rising borrowing costs, rising expenses, moderations of, again, leasing traffic and economic occupancies and such. Going into 2024, I think that we'll hopefully, fingers crossed, we'll see a more predictable, less volatile operating market, in where things will settle, the dust will kind of settle. Owners, operators are going to be adjusting to this new norm, hopefully short-lived. But I do think that next year will really be the year of recovery for a lot of these operators, where we're saying, okay, here's what I have to work with, and here's how we're going to have to move forward to get to the back end of this. So I think next year is the year of recovery, but I definitely think it's going to be a less volatile market than what we've seen. Not as many aggressive or abrupt changes like we've seen in the last 18, 24 months. So at least I hope that's the case for sure.
Yeah.
I agree. Law has proven to be wrong for a very long time now. So,
well, the other flip side to that argument, by the way, I agree with you, and I think 2024 is going to level off. I don't think it's going to be this celebratory recovery that I think everyone was hoping for earlier this year. But I do think we're going to see things level off. I forgot the question I was just going to ask, but whatever. I do want to say, as we wrap up here, for those listening, Cody hosts an amazing meetup in Houston. Do you want to talk about that for a second, Cody, and give yourself a plug? Because I had a great time down there last month. Actually, it's 2 months ago now, and I think anyone who's in Houston that's serious about multifamily and building that network needs to go see Cody. So take a second, Cody, and tell everybody about the meetup.
Yeah, Matt. Hey, man, I appreciate that. And look, don't be shy. You were a guest speaker there, man. You did a great job. You knocked it out of the park, and everybody loved having you there. But yeah, we host a monthly networking event for both active, passive investors in Houston for people that want to learn more about how to get into the space, how to be successful in buying apartments across Texas. And we've had this meetup for 4 years. It's the Apartment Educators Houston networking event, second Thursday of every month. And so if you'd like more information on that, shoot me a DM after this, and happy to send you some information. But would love to see you out there. But it's a great event for anybody of any experience level to come here from guys like Matt who've come and spoken. So love to help you out.
Yeah, awesome. That was good stuff. And by the way, the restaurant where the meetup is at is fantastic. So if you're going to go to the meetup, do yourself a favor, get there an hour early, go eat, have a cocktail, and go mingle with some absolutely fantastic people at that meetup. Both Vanessa and I had a fantastic time. So thanks very much for the invite. It was truly our pleasure, and we will definitely be back down there. So, Cody, where can people find you?
Yeah, man. Well, I'm not hard to find, man. I'm all visible on social media. It's very, very similar to most everybody. You can find me on most of the most popular channels. But man, if you want to just connect with me directly, make sure to just shoot me an email, cody@blueoakinvest.com. Make sure to reference the More Doors podcast, and we'll definitely love to connect with you. And see how we can help you along your journey.
Outstanding. Cody, thanks so much for joining us on the show today. It's been awesome. I appreciate the vulnerability and really kind of the unsugar-coated assessment about where we're at and what guys like us are going through. And I think we're definitely headed into a new chapter in this business. And I think, to your point, right, the folks that can adapt and thrive are the ones that are going to survive. So good luck to you, and I'm sure we'll keep in touch here short term. Everybody else, thanks for joining. Go follow our sponsors, Deep Blue Capital at deepbluere.com. Go check out Tour Studios, and we're going to send in an email to Jesse to get your podcast going. Make sure you say best beard ever, and he's going to hook you up with a little bit of a discount. Maybe mail you some beard butter. Who knows? He gets crazy like that. But yeah, thanks very much for joining. We'll be back again next week. Go hit subscribe on Apple Podcasts or YouTube. Smash that subscribe button, and we'll talk to everybody soon. Thanks again, Cody. Have a great afternoon, brother.
Thanks for having me, guys.